Hey there, fellow investors. Iggy here from the Investing Iguana, ready to dive into some juicy financial analysis. Today, we're going to crack open the vault of company health indicators and explore how financial ratios can give us the inside scoop on a company's well-being. I've got my trusty sidekicks, Ivan and Irene, joining me to break down 3 key points that'll sharpen your investing skills. First up, we'll uncover how financial ratios act like a company's health checkup, revealing its true condition. Then, we'll dig into profitability metrics and what they really mean for a company's bottom line. Lastly, we'll explore why it's crucial to look beyond the numbers when you're sizing up stocks. So, grab your calculators and put on your thinking caps. Ivan and Irene are about to take you on a wild ride through the world of financial analysis.
Ever feel like you need a, a decoder ring just to understand company financial reports? I mean, we've all been there, right? Staring at that jumble of numbers and wondering, what does any of this actually mean?
It's true. Financial statements, they really can seem like their own language.
Right.
But that's where, thankfully, financial ratios come in. They're like that Rosetta Stone that helps us translate all of that data into something meaningful.
And that's what we are diving into today. You've sent over a really interesting collection of articles all about financial ratios. And we're going to break down how you can use these tools to hopefully make smarter investment decisions, like learning the secret handshake of savvy investors.
I like that analogy. We're going to give you the insights to confidently analyze a company's financial health, really understand what's going on kind of beneath the surface.
Exactly. No more feeling intimidated by those balance sheets, right? Let's jump right in with our first source here, 4 ratios to check the financial strength of a company. Now, this article gets right to the point. Can this company even pay its bills?
Which is a pretty crucial question to ask, right?
Yeah.
It's all about liquidity, how easily a company can cover its short-term debts. Think of it like this. You wouldn't loan money to a friend who's constantly struggling to make rent, would you?
Definitely not. So how do we spot those red flags in a company's, finances?
So this article highlights 2 really important ratios, the current ratio and the quick ratio. And both of these ratios look at a company's assets, so the things they own, compared to their liabilities, the things they owe.
Okay, so it's a quick snapshot of their financial wiggle room. But what makes the quick ratio so, quick?
Good question. So the quick ratio focuses on the assets that a company can turn into cash fast. So we're talking cash on hand, money they're owed, easily sellable investments.
Okay.
Imagine a company suddenly gets hit with a massive unexpected bill.
Uh-oh.
The quick ratio tells you how well they could handle that curveball.
It's like checking if they have a financial emergency fund.
Exactly.
But our source, 4 types of financial ratios to assess your business performance, mentions that what's considered a good ratio varies across industries.
Absolutely. You're right. A clothing retailer, for example, has very, very different liquidity needs than, say, an airplane manufacturer.
Because a rack of designer jeans can be turned into cash much faster than a half-built 747.
Exactly.
Makes sense.
The clothing retailer relies on a high inventory turnover. They need to sell those clothes quickly to keep the cash flowing. A low quick ratio might be acceptable for them, but it would be a major warning sign for a company with slower moving inventory.
So context is everything. It's not just about knowing the ratio, it's about understanding what that ratio means for that particular business.
100%.
But let's move on from paying the bills to the question I think every investor really wants to know. Is this company actually making money?
And that brings us to profitability,
Okay.
which is where things get really interesting. The second source we mentioned, 4 types of financial ratios to assess your business performance, dives deep into this.
Okay.
Really good resource.
It's not enough for a company to just exist, right? They need to be turning a profit. And this source gives us 2 key ratios to measure that. Gross profit margin and net profit margin. Now, those sound awfully similar.
They are related, for sure, but there is a key difference.
Okay.
So gross profit margin tells you how much profit a company makes after subtracting the direct costs of producing their goods or services.
Okay. So if we're talking about those designer jeans again, if they're selling for $200 a pop, but it costs $50 to make each pair, that's where we start looking at profit.
Precisely.
Yeah.
But then we have to factor in all the other costs of running that business.
Right.
Rent, salaries, marketing, you name it.
It adds up.
What you are left with is the net profit margin, which is the real bottom line.
And a higher net profit margin is always better, right?
You'd think so, but it's not quite that simple.
Oh, no.
6 basic financial ratios. And what they reveal, this article we have, makes a really important point. A company's profitability should be compared to its industry peers.
So even if a company isn't leading the pack, they might still be in good shape if they're outperforming their competitors.
Exactly. And even a declining net profit margin might not be a reason to panic if the entire industry is facing similar challenges.
Okay. So just like with those liquidity ratios, context is crucial.
It's everything.
But let's shift gears a bit and talk about debt. Now, 6 basic financial ratios and what they reveal warns against companies getting in over their heads with borrowed money.
Yeah, and for good reason. High levels of debt can put a company at risk, especially if interest rates rise or the economy takes a downturn. That's where leverage ratios come in. They help us understand how much a company relies on debt to operate.
This article highlights the debt-to-equity ratio as a key indicator. Now, that sounds pretty self-explanatory. You're comparing the company's debt to the money invested by owners, right?
You got it. Think of it like this. Imagine you're buying a house.
Okay.
Putting down a large down payment means you'll have a lower loan-to-value ratio, which is similar to a company's debt-to-equity ratio. A high debt-to-equity ratio suggests a company is using a lot of borrowed money to finance its operations.
So it's like walking a financial tightrope. A little bit of leverage can be helpful, but too much can be risky. Now, so far, we've focused on a company's ability to pay its bills, its profitability, and its debt levels. But what about the future?
That's where things get really exciting for investors, and that's what we'll dive into next.
Our next source. Here are 4 essential ratios for analyzing companies. Shifts our focus from the present to the future. Because as an investor, you're not just interested in where a company is right. You want to know where it's going.
100%. We're talking about growth potential, that kind of magical combination of factors that gets investors excited about a company's long-term prospects.
And this article lays out 4 key areas to assess: growth, margins, return on capital, and free cash flow yield. So let's break those down, starting with growth. But it's not just as simple as looking at revenue growth, is it?
No, it's more nuanced than that. Revenue growth is important, but it doesn't tell the whole story. This source really emphasizes the importance of free cash flow, or FCF.
Now, we hear that term thrown around a lot, free cash flow. Can you break that down for us non-finance folks? What does that actually mean?
Absolutely. Think of it this way. A company brings in cash from its operations, right? But it also has to spend cash on things like inventory, equipment, and other operating expenses.
Right.
Free cash flow is the money that's left over after those essential expenditures. It's the cash a company has available to, say, pay down debt, reinvest in growth opportunities, or even, return to shareholders through dividends.
Okay. So it's like the financial flexibility a company has to make strategic moves.
Yeah.
It's the money they have to play with after paying the bills.
Yeah. A great way to put it. And investors get really excited about strong free cash flow because it signals a company's ability to generate cash, not just profits on paper.
That makes sense. Now, what about margins? We talked about those earlier in terms of profitability. But this article seems to be looking at them through a different lens.
Right. So here we're talking about how efficiently a company is managing its costs and, squeezing out profits.
Okay.
Are their margins expanding or are they shrinking? This can give you clues about their competitive positioning and their ability to navigate challenges like rising input costs, for example.
So even if a company's revenue is growing, shrinking margins, that might be a red flag that something's off.
Precisely. It's almost like being able to tell if a ship is taking on water, even though it appears to be sailing smoothly on the surface.
I see.
Margins give you that deeper insight.
I'm starting to see how all of these ratios are like puzzle pieces.
Yep.
Like each one is revealing another layer of a company's story.
Okay.
Next up, we have return on capital. Now, this one seems like a no-brainer. Investors, they want companies to use their money wisely to generate even more money.
Exactly. Return on capital measures how effectively a company is using its investments to generate profits. A high return on capital suggests that management is making smart decisions about where to allocate resources.
So it's a measure of how efficiently they're turning investments into profits. Got it. Now, this last one, FCF yield. This one feels a bit more complex. What's the key takeaway here?
So free cash flow yield helps you assess whether a company's growth is justified by its stock price. Basically, it tells you how much free cash flow you're getting for every dollar you invest.
Okay, so it's like a measure of value. You want to see a healthy stream of free cash flow relative to the price you're paying for a share of ownership.
Exactly, and it can help you compare the valuations of different companies, even if they're in completely different industries.
Now, this source also issues a word of caution about stock-based compensation, inflating a company's growth. What's the deal with that?
Yeah, that's a good point. So stock-based compensation, stock options given to employees can be a great way for companies to attract and retain talent, for sure.
Sure.
But it can also muddy the waters when you're trying to assess true growth.
Because it's like counting your chickens before they hatch.
Hmm.
The value of those stock options depends on the company's future performance.
Yeah.
And that's not guaranteed.
You got it. It's important to look beyond the headline numbers and make sure that a company's growth is backed by, solid fundamentals, including a healthy stream of free cash flow.
So we've covered a lot of ground here, from analyzing a company's ability to pay its bills to understanding how to assess its future growth potential. But are we missing anything? Is looking at these ratios all it takes to pick winning investments? So we've covered a lot of ground here, dissecting all these financial ratios like expert investors. But it feels like there's always more to the story, right?
You're absolutely right. Financial ratios are, they're incredibly powerful tools, but they only paint part of the picture.
Okay.
They give you the quantitative side of the equation, the hard numbers. But to get a truly holistic view of a company, you need to look beyond the balance sheet.
So it's like we've been assembling this puzzle, and we have all these pieces that tell us about a company's financials. But now we need to find those missing pieces, the ones that reveal the full picture.
Exactly. And those missing pieces often lie in the qualitative aspects of a business.
Okay.
Things like the strength of their management team,
Right.
their brand reputation, the competitive landscape they operate in. I mean, those factors, they don't show up on a spreadsheet, but they can make or break a company's success.
So can you give me an example of how these qualitative factors might actually come into play?
Sure. Let's say you're looking at two companies in the tech industry. Okay.
Okay.
Both have solid financials, strong growth, healthy margins, all the things we've been talking about.
Mm-hmm.
But one company has a reputation for innovation, consistently coming out with, groundbreaking products, while the other is known for being a little bit slow to adapt to market changes.
So even though their financials look similar, on paper at least, the company with a finger on the pulse of innovation might be a smarter long-term bet.
Precisely. Or consider a company that's facing a lawsuit.
Ooh, yeah.
That might not immediately impact its financial statements,
Right.
but it's a red flag that could signal future risks.
It's like those disclaimers you see in the tiny print.
Yeah.
Sometimes the details hidden beneath the surface are the most important.
Exactly. You have to consider the broader context. Is the company operating in a growing industry? Or are they facing major headwinds? Do they have a sustainable competitive advantage? Or are they constantly playing catch-up?
So it sounds like becoming a savvy investor, it requires more than just, understanding financial ratios.
Yeah.
It's about developing that detective's mindset, piecing together all the clues to uncover the most compelling investment opportunities.
I love that analogy. Think of financial ratios as your toolkit. They give you the means to analyze a company's financial health. But your real edge comes from combining that data with your own research and critical thinking.
And don't be afraid to ask those tough